Hello, it's Shoe Dog Charts. With the stock market at record levels, there's some important questions that need to be asked. If a correction in the stock or bond market comes, will the central bank just buy stocks with printed money like the Japanese central bank? Will there ever be a shakeout of the garbage and junk in the system? Does the decay of capitalism and free markets raise concerns? What stops a central bank from manipulating asset prices? When do they cross the line from marginal manipulation to absolute price control? Unfortunately, there are no concrete answers to these questions, but there are clues. So let's take a look. Following the great financial crisis, the global central banks have collectively been more aggressive than anything witnessed in modern financial history. Over the last 10 years, the six largest central banks have printed unprecedented amounts of money to purchase about 14 trillion of financial assets. That is shown here in this chart. The three goals by the central banks include expand the money supply, drive financial asset prices higher to create a wealth effect, and lastly, generate inflation. One concern from all of this is the massive distortion in financial asset prices worldwide that has resulted. Here's some examples. U.S. bond yields have been among the lowest ever on record dating back to 1776. U.S. equity valuations have risen to levels rarely observed. Over 9 trillion in sovereign bond yields are currently negative. European junk grade debt now trades at yields lower than the U.S. Treasuries. Italian 3-year government bonds are negative, despite the third highest debt to GDP ratio of all developed nations. The Bank of Japan owns over 75% of all Japanese ETFs. The Swiss National Bank now owns 19.2 million shares of Apple, or 3% of total outstanding shares, and 84 billion in aggregate of U.S. stock shares. Now, I'm confident that the Fed and other central banks' influence on markets will only increase in time. However, the next question for consideration is to what extent markets may be bigger than the Fed. Now to this chart, in the upper portion, we see the record RSI, which is the Relative Strength Index. And in previous videos, I've shown you that we're at record highs in the RSI, not only in several individual stocks, but also in the major indices. And in the lower portion of the chart, I agree with the authors that we're in what would be called a blow-off top. Now, when you pump 14 trillion into global financial assets, all sorts of wonderful things can happen, especially if the central banks make it clear in public statements that they will do whatever it takes. Assets will not be allowed to decline. Central bankers have sought to convince private sector players that central banks will never let markets decline, and so the smart strategy was to buy the dips and buy every new high. In essence, buy, and don't bother hedging long positions, as there was no need to squander money on hedges against declines. That would never happen. So now the central banks are facing runaway asset bubbles that are the direct consequence of their promoting the belief that central banks will never let the markets go down. So how do central banks deflate the bubbles? How do they change the market psychology without triggering a crash? In my opinion, and based on history, I don't think it's possible. And this chart here, which shows the cumulative inflation-adjusted asset gains during the last 7 business cycles. Now, 6 of the last 7 business cycles are shown in black, with the current business cycle shown in red. And the chart was from 2017, the third quarter. Therefore, we're a little bit higher here, probably near where that Q4 estimate shows. And on the left side of the chart is the inflation adjusted gains. Now for the current business cycle, from the bottom of 2009 through the third quarter of 2017, the accumulated asset gains was about 139%, thus being the first quarter of 2018, we're probably a little bit higher than that. So now the next chart is going to show us the results of those previous 6 business cycles and perhaps what we can expect for a result of the current business cycle. And then this last chart, which is the theme of this video, and you can take a look at the chart and imagine the ending of the current business cycle. Now my intent is not to be a fearmonger or necessarily a perma-bear. I believe we can look forward to any correction and take advantage of the opportunities that present themselves. And so remember, as Warren Buffett says, be fearful when others are greedy, and be greedy when others are fearful. So I'm looking forward to any correction because I'm prepared, and I hope you are too. So for today, that's Shoe Dog Charts. Thank you.